Hello, friends, and welcome back to Market Shares. I'm your host, Tony Blodgett, and today we're going to talk a little bit about a message that President Trump put out on Truth Social this last weekend. We're going to talk a little bit about the housing market and the government shutdown, which we are in day 7 of as of this recording. So you guessed it, I'm recording this here on October 7th, and we'll be out this Friday morning. So, okay, we're all used to President Trump tweeting. He did it all throughout his first administration, and then now does most of his communicating through Truth Social. So this weekend, we had another, rant kind of from President Trump, and we're going to talk a little bit about this because I definitely have some thoughts on this one. This time, he took aim at Fannie and Freddie and the big builders, home builders around the country. And I just want to read what he said here. So I got to reference my notes so that I get it right. And then we're going to talk about this a little bit. So here's what he said. Before I became president, OPEC kept oil prices high. In a different form, it's being done again, this time by the big home builders of our nation. They're my friends, and they're very important to the success of our country. And here's the key part. But now they can get financing, and they have to start building homes. They're sitting on 2 million empty lots. That's a record. I'm asking Fannie and Freddie to get big home builders going, and by doing so, help restore the American dream. Okay. So, I mean, look, for those of us in the housing market, I mean, I don't, on the face of it, hate this message, right? But here's the question. The first one that came to mind for me is when he says, but now they can get financing. Like, my first thought was like, oh, is Fannie and Freddie now providing financing options to builders? And the answer is no, they don't. I think all of us in the housing industry know that Fannie and Freddie do not provide any sort of financing to builders. Now, in the multifamily space, yes, there are some Fannie Mae backed products that are there for building, larger developments, apartment complexes, things of that nature. That's a whole different story. And that's not what he's talking about here, right? He's talking about home builders. So when he says, but now they can get financing, I'm not sure what he's referencing. I mean, it could be a reference to a few different things. But then my question is, like, what can Fannie and Freddie do to even influence that? Like, maybe he's talking about their ability, just the fact that credit maybe has loosened up at some banks or, something along those lines. But again, nothing to do with Fannie or Freddie. So I just thought this was a weird kind of a statement. But the other part of this that's interesting, because I have heard anecdotally that builders aren't building as much right now. And I don't think it's because of a lack of ability to get capital. I think it has more to do with the current standing inventory that builders are sitting on. So I'm going to talk about that for a minute. But let's be just totally honest. If the president and Bill Pulte, who runs Fannie and Freddie, the head of the FHFA, wanted to actually do something that would spur housing in the United States, let's talk about what they could do to lower interest rates. Because all the president's done, in my opinion, since he's been in office, is egg on the Fed and Jerome Powell to lower interest rates through that mechanism, which we all know does not even directly impact mortgage interest rates. But what could they do? Well, let's look at the G fees that the agencies are charging right now, which is substantially increasing interest rates on every single transaction out there. And more than that, let's look at the LLPAs that they have in place that are very egregious in many cases, not just for purchases, but also for refinance, primarily for refinances, and also, of course, second homes and investment properties and all the like. So I feel like, to mention this whole commentary about Fannie and Freddie getting the builders going without actually addressing the things that they could actually help do is a little bit kind of crazy to me. But let's talk about the builders for a second. Look, we all know that inventory hit its lowest level way back in 2022. And since then, we've seen more houses on the market. Matter of fact, there's still historically pretty low inventory right now. I'm not going to make it sound like there's just this flood of inventory. But there are 863,000 existing homes on the market. There's another 490,000 new homes. Now, obviously, a lot of those are under contract, and so those get counted in that number. But this is below July estimates, and it's 4% above where we were August of 2024. So a year ago, when we had the stats for this, we are 4% above that number. So definitely inventory is growing, not shrinking. And there's some other signs of that I'm going to talk about here in a second. And although, overall supply has dropped a little bit month over month, standing completed units that are not under contract is 120,000 new homes, which historically is kind of this red flag area for home builders when we have that many built homes on the market. And this is despite the substantial incentives that builders have been giving all year, probably for the last couple years, in order to entice borrowers to the table. And these primarily come in the form of significant reductions in the interest rate for those homes. So they do that both through forward commitments. They work directly with a lender. They prepay some points in order to buy down interest rates on a bulk of loans through that particular lender, offering significantly below market interest rates for those homes that they've done that forward commitment on, without cutting into the funds that they have available to do other, approved concessions that might cut into what the lender would allow. It would be 3% or 6% or 9% seller concessions. The forward commitment doesn't cut into that. So they're buying down the interest rate kind of behind the scenes, if you will, to entice buyers, as well as your standard, closing costs, credits, upgrades, things of that nature. And yet we still see, some higher standing inventory for builders. So I don't know, back to the president's statement, what Fannie and Freddie could possibly do to change the current sentiment of builders. Maybe there's something that they're talking about, where Fannie and Freddie could get involved. But it's just an interesting statement. To me, it's very much like, I'm going to talk about my goals to improve housing, but it seems so disconnected from the reality of how our world actually works, because I don't see how there could be any, direct impact. The only direct impact that they could do, like I said, is take a stab at lowering rates, not by pressuring the Fed, although that's fine. If he wants to pressure the Fed, I don't have a problem with that. But they could take actual action without the approval of Congress to lower potentially the G fees or the LLPAs and have a direct impact on mortgage rates like overnight. Bill Pulte, same thing. He's introduced a Vantage score. He's made significant cuts with executives and layoffs and other things at FHFA, but none of which, directly impacts more people getting into homes. So look, I would love nothing more than for this administration, Bill Pulte or whomever has the influence to do it, to make some changes at FHFA, Fannie, Freddie, whatever you can do to help first-time home buyers and existing buyers be able to afford their homes, be able to justify selling a home with a really low rate and purchase your next home. But I have not yet seen any real strategies that would accomplish what it is they're doing. They talk about it a lot, but I'm not seeing any real action there. So in other news around the housing market, let's talk about kind of the fall market. We're setting into fall here. I got to wear my sunglasses in the afternoon and a jacket in the morning. Like, that's fall in the Northwest. At least it's not, full on rain every day yet. But as we set into the fall market, typically things kind of level out. I don't want to say slow down, but definitely, I guess slow down from the height you might see in the spring and summer months all around the country. But what we are seeing right now is that 42% of active listings are having price reductions. 42%. And it's an average of about 4% price reductions. We're also seeing about half of loans that go under contract have some level of concessions from the seller. So what that tells me is that it's definitely an opportunity right now to have some negotiating room if you are a buyer looking to get into a home. You know, I just met with a young family the other day and was talking to them about their journey. And, you know, I think that it was very indicative of the situation that a lot of people are in right now, which is they bought their home, 5 years ago, I think back in 2020, maybe around COVID time. They have a really low interest rate, like 2 3/4 on their interest rate, but their home is just way too small for their family. They've had a couple kids, they have other needs as far as, a larger yard, maybe a nice garage or shop, and things their current home doesn't provide them. And they've just been waiting for something to change. And they're finally at the place where, like, you know what? Rates have come down a little bit, not where we'd like them to be, but we're at a place now where we've built up a lot of equity in our home and we could put up, 20, 25% down payment on a new home. Yes, our rate's going to go from, the high 2s to probably the low 6s. But it's what we need to do for our family at this point. So I see more of this happening, and we need to find ways, creative ways of helping people in that exact situation be able to make that move. That family will free up a first-time home buyer opportunity for somebody at a much lower price point. And there's just not a lot of that out there. But anecdotally, I'm seeing that happening. So what I would tell them, if they want to sell their home quickly in order to get into that new home, first of all, you have some negotiating power, most likely on the home that you're purchasing, right? Chances are the home's going to be sitting on the market for a little bit of time. The average right now for homes sitting on the market, last month, it was about 60 days. This month, it's already climbed up to about 70 days. So that tells us that we are seeing homes wait a little bit longer before they get under contract. It never means that, your dream home might not get snatched out from underneath you, but generally speaking, when you're looking at buying, you're going to have some flexibility. You're going to have an opportunity to negotiate some of your costs to be paid, maybe use that to buy down the interest rate, do what the builders are doing, help get yourself a little bit lower interest rate. You may even be in a situation where you can make a contingent offer if you haven't yet sold your home. But the big key here to making this happen is price your home right. If you want your home to sell quickly, then it needs to be priced right. And if you go at the market a little bit too high, chances are your home's going to sit. And you need to be ready. I would have a strategy with your real estate agent on, look, I really feel the home is worth this. I want to list it there. But if you're not getting activity, if you're not getting people to show up to an open house, if you're not getting inquiries about that listing in the first, week or two that it's live, even just people looking at it, you might want to reconsider your pricing strategy, because homes that are priced well are selling relatively quickly. And that is evidenced in the data. So just a cautionary tale to those that are looking to move up. And I think we have a lot of people right now, we have a lot of families that are wanting to move up, and they're just begging for strategies to do that. Things like bridge loans, I think, are super important to this process. We have an awesome cash buyer program. There's others out there that might help somebody be able to purchase a home with cash before they sell theirs, pulling equity out of their current home in order to have the down payment ahead of time if they could qualify for both payments. Lots of different things. There's loan programs that let you exclude the current payment from your debt to income ratio. So I would be up on all of these strategies, because I think you're going to have more and more buyers coming to you, finally kind of realizing that rates aren't going to come down super low, super fast, and they are just busting at the seams in their current home. And knowing that we have a little bit of a buyer's market, it feels like, with some opportunities to negotiate, it might be the right time for some of these families to get going. So anyway, I wanted to touch on all that. And then lastly, let's just talk about the government shutdown for a minute. Like I said at the top of the show, we're here today, day 7 of the shutdown. And I got to say, I'm not going to talk about the politics that led to the government shutdown. I will just say that it is super frustrating that both sides of our government cannot figure out how to pass a spending bill that everyone can live with in order to keep this government open. This is impacting so many families around the country. The unintended consequences of this are just brutal, and I feel really bad for those people that are in government jobs, people that are in the military. The list goes on of people impacted by this, the small businesses then that are impacted by people's inability to be able to purchase things during this time. The list goes on of the challenges. We need to get this resolved, but here's the problem is I don't see a resolution coming quickly. I hope that I'm wrong. But I don't see a resolution coming quickly. I don't think it's going to be until some significant amount of time passes when paychecks are not delivered to people's mailboxes and the unrest really starts bubbling up, and you see massive pressure from constituents to their legislators, saying we have to fix this. And until we reach that boiling point, I don't see anything, just based on the reporting that I've been watching, that's going to change the stalemate that we currently see with this kind of standoff in the government. So look, I hope I'm wrong, because we need to get this going. Now, as far as how it impacts mortgages, I got to tell you, for me, one of the most disappointing things, besides all the people not getting paid, was that we didn't get a BLS jobs report on October 3rd. I know that sounds silly, but I was really counting on that jobs report to come out and really, kind of, I don't want to say put the nail in the coffin, but really put an exclamation point on what we've seen out of the last BLS jobs report, right after we had that massive revision of the previous data. And I just thought it would be an exclamation point on the fact that the labor market is struggling. And we did see some other reports come out that week. We saw the ADP number. It was atrocious, huge miss. And I expected something similar out of the jobs report, and I think it would have turned the tide in our favor to help improve interest rates a little bit more. Again, I don't see a massive, significant drop, but if we continue to see weakness in the labor market, we know that rates are going to get better as a result of that, and I think that BLS jobs report would have done it. Now, this is interesting, and this was reported on MBS Highway this week, is that they mentioned that the Carlyle Group did put out an estimate of what that BLS report would have said had that been reported on the 3rd, and their estimate was 17,000 jobs. As a reminder, we had a very weak August jobs number, which came out in the beginning of September at just 22,000 jobs, well below expectations. So 22,000. Carlyle Group was predicting that this one would have come out at 17,000. So, I think that would have really shown that we are not creating enough jobs to sop up the demand, and it is more clear weakness in our labor market, and I think justifies future rate cuts by the Fed, which I think everyone's still anticipating is going to happen. Sure would have been nice to have that data to come out. A couple other things that I think are really going to be impactful with this government shutdown. Obviously, they are not issuing new flood insurance policies that are backed by the federal flood program. That's going to have an impact on certain parts around the country, certain communities, cities that you might live in where there's a lot of homes that are subject to flood insurance. This could really delay some transactions from happening. USDA is not issuing new guarantees. The ones that were issued will close, but new ones are not. So that's one of the great zero down programs that's available. And for those people that qualify for it, that are in areas where it qualifies, it's a phenomenal program, and that's going to hurt a little bit. I think what I heard was the HECM mortgages, the reverse mortgages, probably not as timely on those, but still a disruption to business, especially if someone was anticipating, a change to their financial situation because the closing of their reverse mortgage. So, look, it's not like these things go without impacts to the housing market. I think the longer it's shut down, you will start seeing further delays with FHA and VA loans. They're not significantly impacted right now, but over time that could be the case. So look, I'm just hopeful that we can get this resolved, but just know that there is real impact. Talk to your mortgage lender if you're in the real estate industry, or if you're a buyer, about, will my options be limited, or will I be impacted by this government shutdown? I will say, generally speaking, if you look at the last 7 days, mortgage rates have gotten a little bit better, right? The 10 years come down, mortgage rates have gotten a little bit better, despite not getting that, weak jobs report that we were hoping for. Overall, rates have been trending towards improving during the government shutdown. That's not a huge surprise. This is a drain on the overall economy. And typically speaking, anything that is a drain or pressure on the economy as a whole is typically good for bonds and is good for lowering interest rates. So you guys, that's my message for today. I want to thank you guys for tuning in to Market Shares. And more than that, I want to thank you for sharing this with somebody else in the industry. Let people know about the Market Shares podcast, because we're going to continue to bring you great content, great interviews as the year goes on. And if you're already subscribed, you know this, but if you're not, we do drop a new episode every single Friday morning at 10 a.m. Pacific time. So make sure you subscribe to the channel so that you don't miss an episode. And until then, take care.